A nation's prosperity is tethered to the global market by an invisible thread. Domestic growth cannot exist in a vacuum. It is constantly weighed against the relentless flow of international capital. To understand how a modern economy survives this pressure, we must look beyond domestic borders and analyze the precise mechanics of external equilibrium.
The BP equation defines the state of external equilibrium. While the balance of payments always sums to zero in accounting terms, the BP equals zero condition is a specific economic state. It occurs when the current account and the financial account balance each other out perfectly, meaning the central bank does not need to intervene by using its official foreign exchange reserves. For example, if a surge in imports creates a deficit, it must be offset by a voluntary inflow of foreign investment.
We distinguish between these two flows based on what drives them. The current account follows the trade of tangible goods and services, which is largely dictated by domestic income levels. In contrast, the financial account records the movement of investment capital. This side of the ledger is highly sensitive to how our domestic interest rates compare to the rest of the world. Think of it as the choice between buying a foreign product or buying a foreign bond.
The BP curve typically slopes upward. As domestic income rises, citizens buy more foreign imports, which causes the current account to move toward a deficit. To keep the overall payments in external equilibrium without depleting reserves, the country must attract foreign investors by offering higher interest rates. This creates a direct trade-off. A booming economy must often pay a higher price to attract the global capital it needs to stay balanced.
The steepness of the BP curve depends on how easily money moves across borders. In a world of perfect capital mobility, the curve is a horizontal line at the world interest rate. For example, in global financial hubs, even a tiny change in interest rates can trigger a massive flood of capital. However, if a nation has strict capital controls or high political risk, the curve becomes steeper as investors require a much larger incentive to move their funds. In a fixed exchange rate system, the restoration of equilibrium is a forced march. Imagine a nation in an economic boom. As wealth grows, import demand surges, creating a trade deficit. Under a fixed regime, the central bank cannot let the currency depreciate. Instead, it must allow interest rates to rise to attract foreign savers. This differs from a floating system, where the currency would simply lose value to make exports cheaper and naturally fix the trade gap. The Mundell-Fleming model reminds us that no economy is an island. The BP curve acts as the invisible boundary connecting a nation's internal policy choices to the unforgiving reality of the global financial marketplace.